Hey everyone, and welcome back for another deep dive with us. This time, we're going to be taking a look at investment strategies. We found a really cool article on FinShots that we're using as the jumping off point. And you know what really got me hooked about this article? The writer starts off talking about their first ever investment, Arty Industries. And get this, they made a 900% return. I mean, wow, that's incredible.
Yeah, that's a pretty captivating story, I gotta admit. It's easy to see why people would get swept up in the excitement of hearing about gains like that. But the truth is, returns like that are not typical at all. They're possible, sure, but in a lot of cases, it boils down to luck.
Yeah, that makes sense. It's kind of like when you hear about someone winning the lottery. It's awesome for them, but it's not exactly a reliable investment strategy.
Exactly. And that's why the first big point this FinShots article makes is all about education. Before you even think about jumping into the market, you gotta understand the fundamentals. Stuff like reading financial statements and understanding different types of assets.
Right, so it's like learning the rules of the game before you start playing.
You got it.
So no diving headfirst into the stock market just because your buddy gave you a hot tip.
Well, while those tips can be tempting, you can't just rely on them. It's like trying to walk through a maze blindfolded. You might stumble on the right path just by chance, but it's way riskier than having a map, right?
Makes total sense.
Yeah.
So how do we even begin to create that map? The article mentions this thing called Varsity by Zeroda. What's that all about?
Oh, Varsity is fantastic. It's totally free, and it's like this super comprehensive crash course on investing. It covers pretty much everything from the basics all the way to more advanced concepts. And they break everything down into these bite-sized modules, so it's really easy to digest, even if you're a total newbie.
That's perfect. So once we've done our homework on Varsity, are we ready to jump in and start picking stocks?
Hold on there, not so fast. There's another really important point the article highlights, and that's understanding market volatility. See, the stock market doesn't just go up all the time, it goes up and down. And you gotta be ready for the possibility that your investments could drop.
Okay, that sounds a little scary. How much of a drop are we talking?
Well, the article says it's not unusual to see your investments fall by as much as 50% sometimes. I know that might sound alarming, and it is something to be aware of. But the key is to go in with realistic expectations and understand that investing involves risk.
I guess it's kind of like riding a roller coaster. There are going to be drops and twists, but that's all part of the experience.
That's actually a great analogy. The important thing is to make sure you're on a roller coaster you can handle. Some people love the adrenaline rush, while others prefer a smoother ride. And it's the same with investing. Your investment strategy should match your risk tolerance.
Meaning how comfortable I am with the ups and downs without freaking out.
Ex-
So how do we figure out our risk tolerance? Is there like a test we can take or something?
There are definitely some questionnaires and tools out there that can help you figure out your risk profile. But honestly, a lot of it just comes down to being honest with yourself. Ask yourself, how okay am I with potentially losing money in the short term if it means I could make more in the long term?
I guess it also depends on what your goals are, right? Like if I'm investing for retirement, which is way down the road, I might be more okay with taking on a bit more risk.
Exactly. The time you have to reach your goal plays a big role in how much risk you can handle. The longer you have, the more time you have to potentially recover from any dips in the market.
Okay, that makes sense. So we've talked about the importance of education, knowing that the market goes up and down, and understanding our risk tolerance. But with all the different investment options out there, how do we choose where to actually put our money?
Yeah, I agree. It can get a little overwhelming, but this FinShots article actually suggests a surprisingly simple approach. It says we should embrace boring index funds.
Index funds. Those sound kind of plain vanilla, like the most basic option.
Well, they might not be as exciting as trying to pick individual stocks, but that's kind of their strength. Index funds basically just track how a specific market index is doing, like the S&P BSE 100.
So instead of trying to be smarter than the market, we're just going along for the ride.
Pretty much. And you might be surprised to know that research shows 86% of Indian fund managers actually do worse than simple index funds over a 5-year period, meaning trying to pick winners is often less effective than just mirroring the whole market.
Wow, that's a pretty convincing stat.
Yeah.
So are index funds like the secret sauce to investing success?
Well, there's no magic formula, but index funds offer a simple, diverse, and usually low-cost way to get into the stock market. They're like that reliable tortoise in the race, steadily moving towards the finish line without all the drama of trying to be the fastest hare.
I like that. Consistent and reliable definitely sounds appealing. But if we're going with index funds, does that mean we completely ignore individual stocks? What if there's a company we really believe in?
You can definitely have part of your portfolio dedicated to individual stocks if you're comfortable with the added risk. It's all about finding that sweet spot that fits with your overall strategy.
Okay, so we've got education, risk tolerance, and this interesting idea of index funds. It's starting to feel like we're building a pretty solid foundation here, but I have a feeling there might still be some pitfalls we need to watch out for.
You're absolutely right. And one of the biggest temptations investors face, especially those who are new to it all, is greed. We all want to see our money grow, but sometimes that desire can lead us down some risky
Oh,
paths.
I totally get that. It's like those get-rich-quick schemes you see online. They promise crazy returns with almost no effort, and it's so tempting to think, what if it actually works?
It's a powerful temptation, that's for sure. But you got to remember, there's no such thing as a free lunch, especially in the world of investing. If the potential returns are really high, the risks are usually high too.
So how do we resist that urge to chase those shiny but potentially risky opportunities? Is it all about willpower?
Willpower definitely helps, but having a good understanding of the risk-reward trade-off can be even more powerful. The risk-reward trade-off. It might sound intimidating, but it's actually a pretty simple concept. It's basically just about weighing the potential good stuff against the potential bad stuff.
Okay, so like if I invest in some super risky stock that could double my money in a year, I also have to be prepared for the possibility that I could lose half my money in that same year.
Exactly. The article uses this great analogy. Imagine you get the chance to invest in something that could help you put a down payment on your dream vacation home.
A dream vacation home. Sign me up.
But here's the catch. If it doesn't go well, you might have to keep working for another 3 years at your 9 to 5 just to make back the money you lost.
Ouch. Okay, that puts things into perspective. Suddenly, that dream vacation home doesn't seem worth risking years of my life.
That's the power of understanding the risk-reward trade-off. It helps you make smarter choices and avoid getting caught up in all the hype.
So it's not just about going after the highest possible return. It's about finding investments that fit with my comfort level and my long-term goals.
Exactly. And sometimes that means going with investments that might seem kind of boring on the surface, but they can actually offer a more predictable and stable way to grow your money.
Like those index funds we were talking about earlier, they might not be as flashy as trying to pick individual stocks, but they seem like a much safer bet.
They can be, especially for those big long-term goals like retirement. But even index funds aren't immune to market ups and downs. There will be times when the market drops, and that will affect your investments too.
Okay, so no investment is completely risk-free. Got it. But how do we avoid making emotional decisions when those market dips inevitably happen? It's so easy to panic and want to sell everything when you see your portfolio in the red.
You're absolutely right. That's where understanding a bit of investment psychology can really come in handy. One of the biggest traps investors fall into is something called confirmation bias.
Confirmation bias, what's that?
It's that human tendency to look for information that supports what we already believe, even if what we believe isn't actually true. So, for example, if you're convinced that a particular stock is going to be a winner, you might subconsciously ignore any news or data that suggests otherwise.
Oh, I do that all the time. Like when I'm thinking about buying a new gadget, I suddenly start seeing positive reviews everywhere, even though I know there are probably some negative ones out there too.
Exactly. And that same bias can sneak its way into our investment decisions. It can make us hold on to losing investments for way too long, or make impulsive choices based on how we're feeling rather than logic.
So how do we avoid falling into that confirmation bias trap? It sounds like a recipe for disaster.
The first step is awareness. Just knowing that confirmation bias exists can help us be more critical of the information we're taking in and more critical of the decisions we're making.
So be more mindful of where we're getting our info from and try to consider different perspectives.
Exactly. And don't be afraid to challenge your own assumptions. If you're feeling super confident about an investment, take a step back and play devil's advocate with yourself. Ask yourself, what could go wrong?
That's a great tip. It's like doing a pre-mortem for your portfolio, identifying those potential risks before they blow up in your face.
Precisely. It forces you to think about those potential downsides and helps you avoid making those impulsive emotional decisions.
So we've covered education, understanding our risk tolerance, and avoiding confirmation bias. But what about the actual process of investing? Where do we even start?
Well, that really depends on your individual situation and goals. But one of the most important things is to start early.
I've heard that saying before, Time in the market beats timing the market.
Yeah.
But I've got to be honest, I've never really understood what that means.
It's all about this thing called compound growth. It's the idea that the earlier you start investing, the more time your money has to potentially grow.
Yeah.
And those gains can snowball over time.
Can you give me an example? I'm a visual learner.
Of course. Imagine you invest just $100 today. With an average annual return of, let's say, 7%, that $100 could turn into $200 in 10 years, $400 in 20 years, and so on. It's like a snowball rolling down a hill. The longer it rolls, the bigger it gets.
Wow. Okay, that makes sense. So even if I can only invest a small amount right now, it's still worth getting started.
Absolutely. Even small, consistent contributions can make a big difference in the long run. And as you start earning more, you can gradually increase how much you're investing.
Okay, that's encouraging. It makes investing feel a lot more doable, even if you're not starting with a ton of money.
Exactly. And remember, investing doesn't have to be complicated. We talked about how effective those index funds can be. They offer a simple and diverse way to get involved in the stock market.
And they mentioned automating investments through those SIP systematic investment plans. Is that something you recommend?
Absolutely. Automating your investments takes the emotion out of it and makes sure you're consistently putting money away, no matter what the market is doing. It's kind of like setting up a recurring payment. You automatically invest a set amount every month, so it's super easy to stay on track.
It's like setting it and forgetting it, which sounds perfect for someone like me who gets easily overwhelmed by too many decisions.
Exactly. And as your income grows, you can gradually increase those SIP contributions, which makes that compound growth even more powerful.
So we've got starting early, automating investments, sticking to a plan, and it's all starting to click. But with all this talk about growing our money, I'm curious about what happens when it's time to actually use that money. The article talked about selling investments when you're getting close to your goals. How do we know when it's the right time to cash out?
That's a great question. And it brings us to an important idea, understanding the different stages of investing and how our strategy might need to change as we get closer to those goals.
Different stages of investing. I'm all ears.
Think of it like a journey with different phases. In those early stages, when you're far from your goals, you might focus more on growth, and you might be okay with taking on more risk. But as you get closer to where you want to be, your focus might shift to protecting what you've already gained and minimizing the risk of losing those hard-earned dollars.
Makes sense. It's like when you're hiking up a mountain. You might take a more challenging route on the way up, but on the way down, you'd probably choose a safer path. So, as we approach our financial summit, how do we shift our strategy to protect those hard-earned gains? The article mentioned something about moving money to safety when you're nearing your goals. What exactly does that mean?
Safety in investing, huh? It's a tricky one, isn't it? What feels safe for one person might seem totally risky to someone else. It all comes back to that risk tolerance we were talking about. And of course, your time horizon.
Yeah, because let's face it, no investment is completely risk-free, right?
Absolutely. Every investment comes with some level of risk. It's all about finding the right level of risk for you, based on your goals and how long you have to reach them.
So it's not about eliminating risk altogether, but more about managing it in a smart way.
Exactly. Think of it this way. If you're investing for a long-term goal, like retirement, you've got time on your side. You might be more comfortable having a bigger chunk of your money in stocks, knowing that even if things go down for a bit, there's plenty of time for those investments to bounce back and grow.
But if I'm saving for something short-term, like a down payment on a house, I wouldn't want to risk a sudden market crash wiping out my savings right before I need them.
Definitely not. In that case, you'd want to focus on protecting your money, keeping it safe. That might mean going with more conservative options like bonds or even a high-yield savings account. The potential returns might not be as high, but the risk of losing your initial investment is much lower.
Okay, so it's all about matching your investment strategy to your specific goals and timeline. High growth potential for those long-term dreams. Capital preservation for those shorter-term needs. It's like using the right tool for the job.
Exactly. You wouldn't use a hammer to tighten a screw, right? So you wouldn't want to invest in risky, unpredictable assets when you need that money for a down payment in a year or two.
Right. So safety isn't about finding a magic investment that's completely risk-free. It's about making smart decisions based on your individual situation and goals.
That's the heart of it. And remember, as your goals change and you get closer to those goals, your idea of what's safe might change too. That's why it's so important to check in on your investment strategy regularly and make any adjustments you need.
It's like checking your map and adjusting your route along the way to make sure you're still heading in the right direction.
Exactly. And if you ever feel lost or unsure, don't be afraid to get some help from a financial advisor. They can give you personalized advice, help you navigate those market ups and downs, and make sure your investments are still lining up with your overall financial plan.
It's like having an experienced guide to help you through those tricky parts of the journey.
I like that analogy. Having that knowledgeable guide can make all the difference in reaching your goals successfully and safely.
Well, I've got to say, this deep dive has been incredibly eye-opening. I feel like I've gone from feeling completely lost in the world of investing to having a much clearer understanding of how it all works.
That's great to hear. Remember, investing doesn't have to be scary or confusing. With a bit of knowledge, a solid plan, and a long-term mindset, anyone can get involved in the market and work towards their financial dreams.
So what's the one thing you hope our listeners take away from this deep dive?
I'd say it's this. Investing is a journey, not a race. It's about making informed choices, being smart about risks, and keeping your eyes on the prize, even when things get a little bumpy. And remember, time is on your side. Start early, even if it's with just a little bit of money, and let that compound growth do its thing.
That's great advice. It's all about empowering ourselves to take control of our financial future, making those smart choices one step at a time. Speaking of smart choices, what's on the agenda for next week's deep dive?
Next week, we're diving into the world of artificial intelligence and how it's shaping the future of work.
Ooh, artificial intelligence. That sounds really interesting. But I got to admit, I'm not totally up to speed on that. What exactly will we be talking about?
We'll be looking at a really insightful report that explores how AI is changing the job market, creating new opportunities, but also potentially replacing certain jobs.
Wow, I can't wait to learn more about that. It's a topic that's on everyone's mind these days.
Definitely. We'll be talking about both the potential benefits and the challenges that come with this rapidly changing technology.
Well, a huge thanks to all of you for joining us on this deep dive into investing. We hope you found it informative, empowering, and maybe even a little bit fun.
We encourage you to keep learning about these concepts, asking questions, and most importantly, taking action. Your future self will definitely thank you. And be sure to tune in next week as we explore the fascinating world of AI and its impact on the future of work.
Until then, happy investing, and we'll see you next week.